Atlanta, Georgia, March 22, 1899. Two brothers rent a single room on the fifth floor of a building on Decatur Street. One of them, Cator Woolford, used to work behind a grocery store counter in Tennessee, jotting down which customers paid their tabs on time and which ones didn't. His brother Guy is a lawyer. Together, they nail the words Retail Credit Company onto the office door in big black letters, and they start walking door to door, asking local grocers a simple question: which of your customers pay and which ones don't? They write the answers down on slips of paper, 3 words usually: prompt, slow, or worst of all, requires cash. Neither of these men could have imagined what that filing cabinet would eventually become. Within 70 years, the company they started in that single rented room would be holding private files on tens of millions of Americans, files that, according to congressional testimony, recorded not just whether people paid their bills, but who they were sleeping with, what they drank, whether the neighbors thought they were living in sin, and whether they went to church. And that same company is still operating today. You've heard of it. In 1975, it changed its name. It's called Equifax. That is not the story most people expect when they think about their credit score. Most people picture a bank, or the government, or maybe some faceless algorithm cooked up on Wall Street. What almost nobody pictures is a 19th-century gossip network that grew into a private surveillance operation, decades before a single mathematician ever touched the problem. So let's actually trace where the 3-digit number that quietly runs your financial life came from. Because the real story has almost nothing to do with banks, and almost everything to do with the strange, uncomfortable history of who gets to decide whether you're trustworthy. Part 1: The Merchant's Guide. Cator and Guy Woolford's ledger business grew fast. Within a year, the workload had grown so large they needed extra staff just to keep copying entries from grocers' account books into their master list. They bundled their findings into something they called the Merchant's Guide and sold it for $25 a copy, real money at the turn of the century. By 1913, the company had formally incorporated. By 1920, it had 37 offices spread across the United States and Canada. And here's the pivot that mattered most. The retail credit company didn't stay in the business of grocery tabs for long. Insurance companies quickly realized this network of investigators could be useful for something else entirely: checking up on people applying for life insurance, auto insurance, and health coverage. So the company's investigators started knocking on doors, talking to neighbors, coworkers, and landlords, not just about whether someone paid bills on time, but about how they lived. By the 1960s, the retail credit company was one of the largest credit bureaus in the nation, holding files on millions of American and Canadian citizens. And by this point, credit was almost a misnomer for what these files actually contained. Company investigators were compiling notes on people's drinking habits, their marital relationships, their sexual orientation, their political activity, even rumors about their reputations in the neighborhood. All of it filed away, all of it available for sale to insurance companies, employers, and lenders, and almost none of it something the person being investigated had ever seen or agreed to. Part 2: The Scandal That Built the Rules. In the late 1960s, the retail credit company announced it was going to computerize its records. That single administrative decision, moving paper files onto machines, set off one of the first major privacy panics in American history. Privacy advocate Allen Weston wrote in the New York Times in 1968 that transferring a person's file from a manila folder onto a computer wasn't just a technical upgrade. It was a threat to civil liberties, because it made a person's entire past permanently retrievable in an instant by anyone with access. Congress opened investigations. Lawmakers were stunned to learn how much of this information had nothing to do with anyone's ability to repay a debt, and how easily wrong or outdated information could follow a person for life with no way to correct it. The result was the Fair Credit Reporting Act, signed into law in 1970, the first federal law regulating what credit bureaus could collect, requiring them to let consumers see their own files, and forcing them to remove outdated negative information after a set number of years. It was, at the time, one of the most significant consumer privacy laws Congress had ever passed. The retail credit company survived the scandal, but its reputation didn't. In 1975, it rebranded entirely, becoming the company we know today as Equifax, and it kept growing. Part 3, a different story happening at the same time. While the retail credit company was busy building files on the personal lives of millions of Americans, a completely separate and far quieter story was unfolding 2,000 miles away in California. One that had nothing to do with gossip or investigators, and everything to do with mathematics. In 1956, an engineer named Bill Fair and a mathematician named Earl Isaac, who had met while working at the Stanford Research Institute, rented a small apartment in San Rafael, California, and started a company with $800 between them. Their idea was almost radical for the time. What if creditworthiness could be predicted with a statistical formula instead of a loan officer's gut feeling or a stranger's gossip about your church attendance? Fair, Isaac and Company mailed their pitch to 50 of the country's largest lending institutions. 49 of them said no. Only one company, American Investments, agreed to try the system in 1958. For the next 3 decades, Fair-Isaac's scoring formula existed as a niche statistical tool used by a handful of forward-thinking lenders, a world away from being the universal number it is today. The modern FICO score most people picture didn't actually exist yet. That wouldn't come for another 31 years. Part 4. The doors that were never open to everyone. Before we get to how these two separate threads, the surveillance files and the statistical formula, finally merged, there's a piece of this history that almost never makes it into the popular telling, and it matters enormously if you're trying to understand who this system actually served in its early decades. Go back to the earliest days of American credit reporting, in the 1840s. A merchant named Lewis Tappan founded what became the first commercial credit reporting operation in the country, filling massive ledgers in New York City with rumors and character assessments of businesspeople across America. Historians who have studied those original ledgers have found entries openly recommending prudence in dealing with Jewish merchants and describing black-owned businesses in explicitly racist terms. These weren't fringe notes. They were standard entries, written by the overwhelmingly white male credit reporters of the era, and they functioned as an early, informal form of what would later be called redlining, creditworthiness judged not on your finances, but on who you were. That bias didn't stay in the 19th century. For most of the 20th century, an entire half of the American population faced a barrier that had nothing to do with statistics at all: being a woman. Before 1974, if you were a single woman in America, you typically needed a father, brother, or other male relative to co-sign for you, regardless of your own income. If you were married, you generally couldn't get a credit card in your own name at all, only as, quite literally, Mrs. Your husband's name. And no matter how responsibly you managed that account, the credit history it built belonged legally to him. If your husband died or you divorced, that history didn't transfer to you. You could find yourself, after years of perfect payments, with no credit history of your own at all. It took a coalition of women's and civil rights groups, and a bill largely written by a legislative aide named Emily Card, working with Congresswoman Margaret Heckler and backed by Bella Abzug, to finally change this. President Gerald Ford signed the Equal Credit Opportunity Act on October 28, 1974, banning lenders from denying credit based on sex or marital status. 2 years later, in 1976, it was expanded to also ban discrimination based on race, color, religion, national origin, age, and receipt of public assistance. Every single person on Forbes' 2024 list of accomplished women over 50 had been born into a country where none of that was guaranteed by law. This is the part historians most often skip past. For most of its existence, the system that would eventually become your credit score wasn't a neutral, universal measurement available equally to everyone. It was layered with exactly the same biases as the rest of American life, formalized into ledgers and files, and it took targeted federal legislation, not the arrival of a smarter algorithm, to even begin correcting that. Part 5. The merger. By the 1980s, the credit reporting landscape had consolidated dramatically. In the 1960s, there had been more than 2,000 local credit bureaus scattered across the country, each with its own idiosyncratic files and standards. Slowly, through mergers and buyouts, that number shrank to a handful and eventually settled into the three companies that dominate the industry today. Equifax, carrying the direct lineage of the Woolford brothers' 1899 grocery ledger. TransUnion, which started in 1968 as the holding company for a railcar leasing business before pivoting into credit reporting the following year. And Experian, whose roots trace even further back, to a group of English tradesmen in Manchester who banded together in 1826 to share information about customers who didn't pay their debts. All three of these companies had the same fundamental problem. Their reports were massive, inconsistent, and nearly impossible for an ordinary lender to compare side by side. A report from one bureau might weigh a missed payment completely differently than a report from another. There was no common language. So in 1989, the big three credit bureaus partnered with Fair, Isaac and Company, the small statistical firm that had spent over 3 decades in relative obscurity, to build something that had never existed before. A single, standardized scoring algorithm that could take the chaos of everyone's individual credit file and boil it down to one number, on one scale, that any lender in the country could instantly understand. The FICO score, in its modern form, hit the market that year. 33 years after Bill Fair and Earl Isaac started their company with $800 in a rented apartment, their idea became the backbone of the entire American consumer economy almost overnight. Part 6. The number today. Here's where this story lands in 2026. The average American FICO score currently sits around 715 to 717, though that average actually dipped slightly in late 2025, the first decline in over a decade, driven largely by rising credit card balances. According to corrected estimates from the Consumer Financial Protection Bureau, roughly 7 million American adults still have no credit file at all, and another 25 million have files too thin or outdated to generate a score, meaning somewhere around 32 million adults exist almost entirely outside this system, unable to be evaluated by it at all. And that population isn't evenly distributed. Black and Hispanic consumers remain considerably more likely than white or Asian consumers to be either credit invisible or unscorable, a disparity that traces an uncomfortable but direct line back to the same populations who were underserved or actively excluded by the earliest versions of this system. Your score today doesn't just determine your interest rate on a car loan. In most states, it can affect your car insurance premium. Landlords use it to decide whether to rent you an apartment. Some employers, particularly in finance, are legally permitted to check a version of it before hiring you. A number originally built to help a bank decide whether to extend you a $1,000 loan now quietly touches nearly every major financial decision in your adult life. And the exact formula FICO uses to calculate it has never been made fully public. And there's one more chapter to this story that belongs here, because it says something important about how much power these three companies still hold over your life. In September 2017, Equifax announced that hackers had breached its systems and stolen the personal data of approximately 147 million Americans, social security numbers, birth dates, home addresses, in some cases driver's license numbers, more than half the adult population of the country. A congressional investigation later concluded the breach had been entirely preventable. Equifax had known about the security vulnerability for months and simply failed to patch it. The company eventually agreed to pay up to $700 million in settlements. Think about what that means. The same company that built its identity on being trusted to judge whether you're responsible enough to lend money to, failed catastrophically at protecting the most sensitive information of over half the country, and mostly kept operating exactly as it had before. Part 7. What historians get wrong. So what does the popular version of this story usually miss? It misses that the credit score wasn't invented once, by one person, in one moment. It was assembled from two completely separate histories that didn't intersect for 90 years. A 19th-century gossip and surveillance network built by two brothers in Atlanta, and a mid-20th century statistical experiment built by two engineers in a rented California apartment. Those two threads only merged in 1989, which means the objective, math-based credit score most Americans assume has always existed is, in the full sweep of this history, barely 37 years old. It misses that, for most of this system's existence, it wasn't equally available to everyone. It carried the racial assumptions of 19th-century credit ledgers, and it legally excluded half the adult population from building independent financial identities until 1974, not because the math didn't work for women, but because the law simply didn't require anyone to lend to them on their own merit. And it misses, maybe most importantly, that this entire system, the one now deciding your mortgage rate, your insurance premium, and in some cases your job prospects, was built almost entirely by private companies, not by the government, operating with remarkably little public oversight until Congress was forced to intervene after a privacy scandal in 1970. The three-digit number so many Americans treat as an objective fact of nature was, and still is, a proprietary formula owned by a for-profit corporation, built on data collected by three other for-profit corporations, one of which has a direct institutional lineage running back to two brothers writing prompt or slow next to their neighbors' names in a rented office in 1899. None of this means the system is worthless. Before any of this existed, credit was based entirely on who you knew and who was willing to vouch for you, a system that could be just as biased, and often far more arbitrary, than anything that followed. Standardized credit scoring genuinely did open financial doors for millions of Americans who had no personal connections to a banker. That part of the story is real too. But the next time you check that number, the one between 300 and 850 that somehow feels as permanent and official as your social security number, it's worth remembering it isn't natural and it isn't neutral. It's the product of a grocery clerk's ledger, a privacy scandal, a mathematician's apartment, a decades-long fight for women's financial independence, and a 1989 partnership between four private companies that decided together what your financial identity would look like from that point forward. Historians who reduce it to banks needed a way to measure risk are leaving out almost the entire story: the surveillance, the exclusion, the accident of timing, and the very human decisions, made by a small handful of people you've never heard of, that quietly built the number now sitting behind nearly every major financial decision you'll ever make. If this is the kind of history you actually want more of, the stuff that's sitting behind the numbers and institutions you deal with every single day, but that never gets explained anywhere, this channel exists for exactly that. Subscribing is honestly the easiest way to make sure these videos actually find you instead of getting buried, and it costs you nothing but genuinely helps this keep going. I'd love to know. Drop a comment and tell me what state you're texting from right now. I always read through them, and I'm curious how far across the country this reaches. And I want your take on something. Out of everything in this video, which part surprised you the most? The fact that credit bureaus were investigating people's personal lives decades before anyone thought about statistics, or the fact that women couldn't build independent credit history in this country until 1974? Let me know below. I'll see you in the next one.